Cenovus Energy just delivered one of its strongest quarters on record, and its CEO spent the earnings call warning investors that the industry behind that quarter is structurally broken. That contradiction is not a PR fumble. It is the signal that tells you how to position these stocks before the market prices what McKinsey already knows. The consensus reading of a strong quarter is that operations are healthy and the stock reflects fair value. What that reading misses is that McKinsey's warning was not about the next quarter. It was about the next decade of capital allocation decisions that global investors are already quietly making about Canada. McKinsey said Canada has spent over a decade becoming one of the least attractive places on Earth to develop oil sands. That is not a political complaint from a frustrated executive. That is a CEO telling his own shareholders that the growth runway supporting the stock's long-term multiple is narrowing, even as current production metrics look strong. The market tends to price energy companies on their current cash flow yield, but the terminal value of an oil sands asset depends on whether the next investment cycle materializes, and McKinsey is saying that cycle is at risk of never arriving.
Canadian Natural Resources posted Q1 2026 production of 1.64 million barrels of oil equivalent per day, with a 4% year-over-year increase and upgrader utilization running at 106% in April. That number sounds like a growth story, but CNRL's own president says it is actually the problem. Scott Stouth told analysts the industry cannot grow oil sands in any significant way without a new West Coast pipeline capable of moving 1 million barrels per day. Production is not stalling because operators are inefficient. CNRL's synthetic crude oil operating cost of $23.73 per barrel is an industry-leading figure. Production is stalling because the barrels have nowhere to go. This is the piece of the story that rewires the valuation logic. Efficient operations are compressing cost curves and generating strong current cash flows, which is why dividends like CNRL's 625 basis point quarterly payout and its 5.6% yield look sustainable today. But a company running at 106% upgrader utilization with no approved pipeline for expansion is a company that has fully harvested its current asset base. It is not building the next one. Raymond James upgraded CNRL to outperform this week, presumably on the strength of those operational metrics. The upgrade is defensible on a cash flow basis, but it does not engage the structural question. What does the growth multiple look like if the West Coast pipeline stays politically blocked and no new oil sands phase gets sanctioned in this decade?
Here is what most coverage of these earnings calls is missing. The warning McKinsey delivered is not about future projects being delayed. It is about a regime shift in how global capital classifies Canadian oil sands as an asset category. When a sector's leading CEO uses a record earnings call to warn about investment exodus rather than celebrate results, institutional allocators read that as a signal that insider confidence in forward growth is already broken and that the current cash flow is being managed for return rather than reinvestment. That repositions these stocks in a portfolio from a growth and income holding to a pure yield extraction play. Murray Edwards, executive chair of CNRL, added this week that the Pathways Alliance carbon capture project needs better rules to attract investment before it can move forward. The carbon capture commitment exists, but the policy framework that would make it financeable does not. That gap matters for capital flows because the ESG-constrained pools of capital that might otherwise re-enter Canadian oil sands are waiting precisely for that framework before they reallocate. Suncor shares fell this week despite record upstream production and increased buyback plans, a market telling the company that operational strength is not enough to offset the discount the market is applying to the sector's growth narrative. That price action is the market pricing the structural story, not the quarterly story.
The downside path is already partially visible in price. If the West Coast pipeline remains politically blocked and Canadian policy on oil sands investment does not shift within the next 2 to 3 years, global capital will continue to reallocate away from this sector, and the premium these stocks once carried for production growth will compress permanently into a pure yield discount frame. The recovery path runs through two conditions that McKinsey's warning implicitly defined. The first condition is a policy shift that restores investment competitiveness, not a single regulatory approval, but a durable framework change that allows the next oil sands phase to be sanctioned with confidence. The second condition is pipeline approval, specifically the West Coast line that Stouth and Edwards both named as non-negotiable for meaningful growth. Neither condition requires oil prices to cooperate. Both conditions are purely political, which means they are binary and hard to time,
but also potentially fast-moving if a federal government changes its calculus on energy revenue. The benchmark Mackenzie set on that earnings call is the one to watch. If Canada remains, in his words, one of the least attractive places on Earth to develop oil sands, then the strong quarterly numbers these companies are posting are the peak of what current infrastructure can produce, not the foundation of a growth story. If that policy calculus shifts, the same operational efficiency that is generating today's cash flows becomes the base of a reinvestment cycle the market has not priced. The record quarter Mackenzie delivered is either the last proof of a great business before its growth era ends, or the proof of concept on what the next phase could be if Canada decides it wants one. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.